Benjamin, the Bank of Canada recently raising that overnight rate to 1%. The Governor, Tiff Macklem, mentioned that Russia's war on Ukraine introduced a new sense of uncertainty with respect to Canada's outlook. He had suggested that the economy is strong. We've recovered from the pandemic. However, inflation is higher than the bank had thought, and consequently, interest rates need to go higher. The language is pretty clear. What do you take away from this?
Yes, absolutely. The Bank of Canada is more concerned about inflation, and they are starting to admit it. What they care about is not inflation today. What they care about is inflation expectations, what we expect about inflation a year, 2, 3 years from now. They would like to control those expectations and to make sure that people understand that those inflation expectations are not going to be elevated. That's the number one goal. So they raised their inflation forecast, quite frankly, and blaming basically the situation in Europe as the main reason, rightly so. Now, we have to remember one thing. The Bank of Canada can do very little to impact inflation coming from Ukraine, Russia, and supply chain, but they can impact demand. And if you look at the inflation now, and that's the point that the Bank of Canada is making, it's more broadly based. It's not just supply chain, as was the case in the beginning, it's also demand. And here they can do something by raising interest rates. And that's exactly the message that we got this morning.
Couple of things that you had mentioned there. Let's get into the pace of it. The Bank of Canada signaling that rate increases from here on in will be more aggressive. Where do we end up? Do we end up at that 2% policy rate? I heard the governor say that we're focused more on inflation targets and not rates targets.
Yes, that's a very good point. But we have to remember a few things. First of all, there is the market and what the market is expecting the bank to do. And this market is expecting the Bank of Canada to go basically in a straight line to about 3%. That's what the market is expecting. The Bank of Canada is telling you, listen, there is something called the neutral rate, the rate where we want to achieve in which the economy is not moving too quickly or too slowly. It's basically a balance, neutral. And they expect this neutral rate now to be 2.5, higher than 2.25 before. So they are raising it, basically allowing them to raise interest rates a bit higher. Therefore, the market is expecting 3%. The Bank of Canada would like to go to 2.25, maybe 2.5, and let's see what happens. But that's basically the story now. Regardless, in the very near term, over the next 6 months, interest rates will be rising very, very quickly. We have to be ready for that.
Benjamin, you had mentioned global inflationary pressures, commodities, of course, pushing higher, supply chain issues abound. Can Canada's economy handle higher rates?
As a society, as an economy, we are more sensitive to the risk of higher interest rates. Remember, interest rates were very low for a long period of time. The boom in the housing market is all about low interest rates. People moving very fast on the market to take advantage of those low interest rates. Now they're starting to rise from a very low base. Clearly, that will slow down the housing market, and the Bank of Canada is counting on that. At the same time, the Bank of Canada is saying other things. They're saying, we know that interest rates are rising, but at the same time, companies are going to invest because they need to increase capacity. That's something that they are very optimistic about. Also, they see productivity rising. And remember, productivity is the number one protection from inflation. If I give you a 10% increase in your wage and you are 10% more productive, that's not inflationary. So any increase in productivity will be very beneficial to protect us from inflation. And that's what the Bank of Canada is counting on. Therefore, they believe that there's no need to raise interest rates to the sky because productivity will take care of the situation. Let's
get into some of those growth numbers. The bank has suggested that we'll see growth at about 4.25% this year, and I guess next 3.25%, and then down to 2%. What do you make of those numbers?
Yes, those are very optimistic numbers, but they are reasonable. Why? Because we have a lot of pent-up demand going on in the economy. The hidden assumption here is that 2022 is a transition year from a pandemic to an endemic. Things will improve when it comes to the virus, and therefore you will see this pent-up demand being utilized in the economy, especially in services. So they see services rising very quickly. They see business investment rising. for the first time in a few years, businesses will be increasing capacity, and productivity will enhance the ability of the economy to grow. And therefore, they are very optimistic about economic growth. Maybe a bit too optimistic, but overall reasonable.
The Bank of Canada governor was quoted as saying that the new budget was not included in the Bank of Canada's outlook and forecast today. As you see it going forward, budget 2022, does that affect the bank's forecast going forward?
Yes, the government was facing a dilemma. On the one hand, you have the Bank of Canada monetary policy trying to slow down the economy and inflation. On the other hand, they got so much money from revenue because of taxation and the economy doing better, and they had to decide what to do with all this money. They decided to keep it basically safe and keep it neutral. Basically, they used this money to spend, but at the same time, they relied on those huge numbers of revenue dollars that they got in order to make sure that the deficit is not too significant. So it's basically neutral. So you have monetary policy tightening, and the government decided to stay neutral in order not to basically sabotage what the Bank of Canada is doing.
And lastly, given the measures that were introduced in Budget 2022 and the Bank of Canada increasing that overnight rate, what does that do to Canada's housing?
Well, it's a very important factor. As you know, housing was a major contributor to economic growth, and it will slow down because of higher interest rates. Now, the government is trying to do two things, which is very interesting. On the one hand, they are encouraging demand for housing by giving those young borrowers this tax-free savings account, $40,000. That's going to increase prices. At the same time, they are going to allow for supply to rise. That will put downward pressure on the prices. So you have two offsetting forces here. It's like putting a humidifier and a dehumidifier in the same room and let them see who is going to win. That's basically what we are seeing now when it comes to housing policy coming from the government. Overall, it will be neutral, and therefore the main number to look at is interest rates and how high they will be rising. Clearly, this housing market is very sensitive to the risk of higher interest rates, and I believe that this housing market will slow down, and that will be a very good thing.